For Morningstar, I'm Jeremy Glazer. With stocks hitting record highs, many are worried about valuation levels and how to invest in this market environment. I'm joined today by Josh Peters. He's editor of Morningstar's Dividend Investor, and also Morningstar's director of equity income strategy for how he thinks about investing in a fully valued market. Josh, thanks for joining me today.
Good to be here. Tough topic, though.
So let's actually start a little bit with your just general thoughts about where the market is today, how you think about valuation levels. Do you see stocks as being horribly overvalued, as fairly valued? How do you think about it?
I see the market overall as being kind of in that fairly to maybe slightly overvalued area. That's what the bottom-up product of our analyst fair value estimates indicate for the U.S. market. I think it's also consistent with a lot of other types of metrics. You look at longer-term PE ratios. We're kind of in the middle of the range of the last couple of decades. Perhaps there's going to be an upsurge in growth, and the stock market can take off on that basis. But we've had a lot of expansion in the PE multiple of the market. That's what's really driven the bulk of the gains from the S&P 500 over the last 2 years. I think that is probably run most of its course. So really what you're looking at from here is a combination of dividend yield and growth in earnings and dividends per share to drive long-term total return. What you don't have really is a cushion. I would really much rather be buying stocks at discounted valuations that reflected very low expectations for economic growth and incorporated a sense that there are perhaps more risks and bumps in the road ahead. That, unfortunately, is not really what you get today. You look for bargains, and that you might well come up dry.
So I take it you're not finding anything that looks particularly attractive.
Well, there are certainly some businesses that I really like. Magellan Midstream Partners, for example. It's our largest portfolio holding, has been for many years. The company has grown its distribution at a very rapid rate, but now the units only yield about 3%. Back in the middle of the last decade, it would be more typical for Magellan to yield 5 or 6%. Now the growth has certainly helped justify a lower dividend yield or a higher price to dividend ratio, if you want to think about it that way. And it's a very low-risk business with a built-in hedge against inflation. They can automatically raise the per-barrel tariffs on their refined petroleum products system by a formula that is linked directly to the producer price index. So certainly still a very attractive business, but it's trading above our fair value estimate, a couple dollars above. The yield is a lot lower than people have traditionally expected from MLPs. It's the kind of name that I can hang on to, but it's not a name that I would buy at this point.
But then what do you do with new money? Let's say you're a new investor, you have some money to invest. What do you do with that cash right now?
I think the first thing you have to do is think about what it is that you're trying to accomplish. And it's very easy for people's goals to be sort of malleable and evolve in some unpleasant ways over time. If you're looking to play the market, even the market for dividend-paying stocks as a value investor, that's going to be kind of tough because there's not a lot of bargains out there, as I said earlier. If, on the other hand, you're looking to generate income from the equity piece of your portfolio, then I think what you do is you make a permanent commitment. I'm going to put this money into this strategy. I'm going to leave it there indefinitely, whether that's 10, 20, 30 years, however long you've got to go to retirement and beyond. Say, I'm going to let the dividends do the work. I'm not going to get bent out of shape if at some point along the line prices have fallen 10, 20, 30%, as long as the dividends are still being paid. And then you make sort of a trade in your head. Say, I like to use this analogy to an annuity. Let's say, you've retired, you're on in years, you have $500,000, okay? You might be able to find an insurance company that is willing to trade you. They will take your $500,000 and then they will promise you, say, $2,000 a month of cash for life. Okay, well, now you have a predictable stream of cash. The $500,000 is gone, now you have the stream of cash. Now, if interest rates go up, the theoretical value of that annuity has gone down. That is just how the math works. But if you're an annuity holder, you're probably not thinking about it that way. You're thinking, okay, well, I'm still getting my $2,000 a month. I think it's possible to adapt that type of mental framework for looking at dividend-paying stocks. That you could say, take that $500,000, invest it at an average yield of 4%. That's $20,000 a year of annual income. Now, the purpose from there is just to make sure that none of those dividends get cut, that the dividends continue to grow over time, but what you're buying is a stream of future cash flow. You're not buying something that you have to watch the balance every minute of every day because you need to cash out of the market in order to meet your bills. You let the dividends fund your portfolio withdrawals. Now, at some point in the future, especially from this price level, there's a decent chance that the value of that portfolio will be lower than it is today. But what are the alternatives? I don't think the alternatives are more attractive. I think actually far less attractive from the standpoint of an income investor. You either make commitments to long-term bonds at even lower yields and no growth of income. You can just go in an income agnostic fashion into other areas of the market and just hope and pray that you get the capital gains you need in order to fund your portfolio withdrawals. In other words, I think that higher yielding, high quality stocks are still the best best available option in this sort of fully valued market.
You see those stocks attractive, but you're also holding a fair amount of cash in your real money portfolios in the newsletter right now. Why are you holding on to that cash? Do you think it makes sense to have some dry powder right now?
Yeah, what I do is I make a distinction between the permanent commitment that you make to a particular strategy and the commitment you make to individual stocks. The real money portfolios that we have, it's not like I'm going to take some of the money in our Builder and Harvest portfolios and go decide to buy Google or Netflix or something like that. That is not part of our strategy. What's there is committed to dividend-paying stocks, to establishing a good stream of income and then growing that income over time. It's, I think, a very simple proposition. But within those two accounts, there are going to be times when the individual stocks that we own may no longer meet our needs. And there can be a gap in some cases, as right now, between selling some of the stocks that aren't working for us, where the risk characteristics aren't that great or the valuation is unattractive, and then being able to redeploy those funds into other stocks. So right now, about 5% of each of our portfolios is sitting in cash. I'm looking to get that reinvested here over the next couple of months. I don't think that it's a bad thing to take time and consider our choices carefully. I don't have to rush in to make sure that we're 100% invested all of the time. But if you think about this type of formula within the broader framework of an investor's portfolio, you make a commitment, say 40%, I don't know what number it might be, but 40% of my portfolio I'm committing to dividend-paying stocks. I think you could leave that money there within the portfolio. You don't want to be married to any individual stock. You want to buy them, I think, with an indefinite holding period in mind, perhaps forever, Warren Buffett's favorite phrase. But you don't want to ride bad situations into rocky territory. So where we're at right now is not a lot of bargains, but still roughly half of our portfolio holdings are still trading under fair value. That's not too bad. That's enough to work with. At this point. Another way of saying is I don't think you need to raise cash because valuations are so unattractive that you'd literally rather own cash over the next 5 years than these dividend-paying stocks.
Josh, I appreciate your insight today.
And thank you too, Jeremy.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.